Welcome to Bloomberg Technology. I'm Emily Chang, currently sheltering in place in San Francisco. Markets ending the week in positive territory despite a slew of dismal economic data. U.S. retail sales plunging in April, even worse than March, a new record drop. Store closures and bankruptcies continuing to happen across the country. This as the Fed issued a stark warning that the value of stocks and other assets could see significant declines, with commercial real estate being among the hardest hit. Meantime, in New York, beaches planning to reopen in time for Memorial Day, as well as clubs in Florida. This as there's been a resurgence of the coronavirus in Texas. I want to bring in Taylor Riggs, our Bloomberg Markets correspondent, who's been digging into the movements of the day. So, Taylor, early losses, late gains. Where did tech land?
Yeah, sort of the second day in a row, right, where we've had some early morning losses that slowly transition into some gains here in the afternoon. Tech, though, for a second day outperforming the S&P 500, but it's not coming from big tech. The NDX, which is the NASDAQ 100, the big tech stocks, the underperformer here. So you're really not getting the leadership from big tech that you would expect in a rally. Again, this is the second day where big tech has sort of lagged and been the underperformer within all of the tech stocks. You mentioned some of the retail sales, the industrial production, all bad news. On the flip side of that, consumer confidence was much better than expected. So that's where you're getting some of these small cap stocks like the Russell 2000, for example, that are really focused on the domestic consumer. That was the big outperformer. So that could provide some indication of why perhaps there's a little bit of a shift today in some of the small caps being the big outperformer. Finally, though, Michael Shaoli over at Marketfield Asset Management said big tech valuations are not egregious. He's taking a look at the forward PE ratios of Alphabet, Facebook, Microsoft, all cheaper than the average of 2018. If that's the case, these big tech stocks could come back and provide some leadership.
Meantime, Taylor, Alphabet shares actually down after hours. This after a Dow Jones report that the DOJ in various states are likely to pursue an antitrust suit against Alphabet. This is something that we have been continuing to follow. Also, we saw chip stocks down, warnings from Foxconn, of course, Apple's biggest supplier, that they don't expect smartphone demand to recover. In fact, that recovery will be quite uncertain. Walk us through some of the other trends.
Yeah, let me break some of the stocks down for you. I'll start with the chip stocks there. Actually, we're showing Alphabet. So let me start with Alphabet. They're recovering some of the losses earlier, down as much as 2.4%. So perhaps analysts and investors taking a little bit of a breather here, that we have been hearing about this antitrust news, these lawsuits for about a year now. We also know that according to Dow Jones, that the DOJ and some states could be bringing a case maybe as soon as this summer. State attorneys general may be bringing a case in the fall. So on one hand, there could be some frustration really about the lack of cohesion here. If you have Alphabet fighting multiple different fires on multiple different ends from states and the DOJ and all different fronts. But on the other hand, again, we've been hearing about this for some time. You really do wonder if this was in part why there was a lot of underperformance of Google and Alphabet in 2018, when you did have a lot of big outperformance by some of its other peers and big tech stocks. So again, only down there just a little bit in after hours. Around the chip makers, you mentioned those as part of big government taking action against big tech. We did get some confirmed reports here from the U.S. that they want to crack down on Huawei's ability to access some of these chip makers. So this is an escalation against the Chinese company. This could further now freeze out the Chinese company Huawei in getting the chips it needs to make its products. That's why you saw a lot of chip makers fall as well. And then Foxconn, as you said just briefly here, saying that second quarter revenue will drop 15% relative to first quarter. That goes against what we heard from companies like Apple that said in April demand was starting to turn around. Foxconn last night seemed to think that the second quarter was going to be way worse than the first quarter. So giving us some evidence that things might not be as good as they think. So a lot of the components in the chip makers for Apple also falling on all of this news.
Meantime, let's talk a little bit more about Apple. Apple starting to reopen stores in the United States, also planning to reopen stores soon in Italy. We know from Foxconn they expect smartphone demand to remain uncertain, and we of course saw their profit plunge. But what are the early signs we are seeing from Apple otherwise?
Emily, I think the guest, Dan Ives, who is coming after me, might have an opinion on this, but let me just set it up for you. As much as Apple wants us to think that they're a services company, 82% of the revenue comes from products. 55% of the revenue comes from the iPhone, then it comes from Macs, iPads, and wearables. So they need the stores to open because we cannot sit at home and just buy their services and that recurring revenue that Apple loves so much. Big portions of their company is still dependent on that iPhone, on getting consumers back into the stores. I wonder if maybe Dan Ives has some opinions on that. I'll leave him to explain that further.
All right, Taylor Riggs for us in New York. Taylor, thanks so much. And as Taylor mentioned, we do have Dan Ives of Wedbush Securities on the line. Of course, Dan, always love hearing your thoughts on Apple. We got these really dismal numbers today from Foxconn, them saying that smartphone demand remains uncertain, and yet Apple is moving forward, starting to reopen stores in Italy and already across the United States. What is your outlook?
Look, it speaks to what's going to be a very uneven outlook over the coming months and quarters, with some dark days ahead. Although right now investors are really focused on iPhone 12. As that gets released, we believe November, December, possibly by October. And that's the light at the end of the tunnel. No doubt this is going to be a very uneven recovery for Apple. But I think what you're seeing from Foxconn, this is going to have a lot of twists and turns. And that's something you're seeing in the stock, combined with the Huawei situation, which just escalates the U.S.-China worries, with Apple the poster child for any issue in China.
How much does the physical store today matter to Apple? Is it a nice to have to continue to drive sales, or is it really a need to have?
It's a great question because let's call it 7 to 10% of revenues come from the stores, most coming from online. But the iconic Apple brand, the golden brand that Cupertino and Cook have built, it's based around the stores, the experience, to see the products. That's part of the aura of Apple. And that's why when you look at the opening of the stores, both overseas and you're starting to see some in the U.S., it's important in terms of laying the seeds for what's going to be the next chapter of this recovery from these dark days that Apple, as well as every other company out there, is seeing.
So how optimistic are you about smartphone demand recovering in the second half of the year, knowing that we're still in this? We don't know when we're coming out of this. Some states are starting to reopen. We're seeing this resurgence in Texas. It's really unclear what the next few weeks look like, let alone the next 6 months.
Yeah, it's going to be very turbulent for Apple as well as other companies. But from an investor perspective, you don't know what's going to happen in the next 10 minutes, let alone the next 3 months. That's why with Apple, I focus on just the pure numbers. 350 million of 925 million iPhones worldwide have not upgraded their phone in 42 months. So there's strong pent-up demand there. And as Taylor talked about, combined with the services business, which we believe things worth about 5 to 600 billion. You combine that, that's the 1-2 punch on the other side of the dark valley. And I think that's really what investors, and that's why the stock's holding up relative to obviously a lot of the Category 5 headwinds that we're seeing for Apple.
All right, let's talk a little bit about Tesla. Of course, a lot of news from Tesla this week. Elon Musk daring police to arrest him as he reopened his factory and defied county orders. It certainly looks like now California is on side, and Tesla is making cars again in Fremont. That said, what is your outlook for Tesla, given that if we're not buying phones, we're certainly not buying cars right now?
Yeah, the Fremont standoff, it's important in terms of from an investor perspective, because as they produce cars, they're not burning as much cash. And that fundamentally is why you start to see that stock work in terms of this old Western standoff between Musk and the state of California and Alameda County. But it comes down to China. China right now, how quickly could they get to 100,000 units? What does demand look like? We are seeing a significant ramp in China. as we go into May and June in terms of Model 3. And investors are looking not at June, you're looking at September, December as to more of a normalized run rate here. And it comes down to the P word, profitability. Can they do this profitably? That's why the stock continues to hold in here, because of that navigating the cost structure with some of these just massive headwinds that they're seeing, just given the overall demand environment.
I'm curious about your thoughts on Musk's leadership right now. I mean, obviously, he's a very polarizing figure. We had our own Bloomberg opinion columnist, Tim O'Brien, write a piece this week saying Elon Musk is many things, wise is not one of them. Can we stop listening to him now? Of course, Musk has, over the last couple of months, underestimated the impact of this pandemic and how painful it would be. That said, he's gotten his factory to reopen despite it being temporarily against the law. I mean, do you still think that, Musk is doing a good job here?
Yeah, definitely a lightning rod situation. And as you said, polarizing, because to some, the standoff in Fremont, as I'll call it, puts Musk, in terms of the loyalist, even in a better light. He stood the ground, opened the factory. But then on the other hand, in terms of just health and safety and other issues, there's obviously a brighter spotlight in the broader situation. It comes down here to, can Musk and Tesla navigate the storm, stay profitable, and can they start to see Model 3 demand ramp back up? And from an investor perspective, that's going to be the question. From a leadership perspective, look, Musk, has talked and obviously walked the walk, but this is only one chapter. We got to see how other chapters play out in terms of how this book's written. But at least in this stance, definitely put a pretty strong line in the sand. And ultimately, there's risk in that, as well as some potential opportunity from restarting the factory.
All right, Dan Ives of Wedbush Securities. Always good to have you calling in, Dan. Thank you so much for stopping by on this Friday. All right, coming up, more on leadership in a time of crisis. We'll talk to another CEO about how he is running his company next. This is Bloomberg. Across the world, the numbers are staggering. Hundreds of thousands dead, tens of millions of people unemployed, and more to come. In a time like this, people are desperate for leadership they can trust in both the public and private sectors. Joining me now is a CEO who's been on some of the lists of the top companies to work for, Alex Shootman, the CEO of Workfront, who recently penned a piece on leadership in a crisis. Alex, thank you so much for joining us. I was recently speaking with Mark Benioff, the CEO of Salesforce, and he admitted to me, this is my first pandemic. I don't know what I'm doing, actually. I'm just learning as I go. Is that something that you would echo?
That's right. When we put together our corporate calendar for the year, we did not pencil in a pandemic. And so I think for all of us, I echo Mark's sentiments. For all of us, we're learning to manage this as we go. But there's some things about this crisis that are same as every other crisis. And you can kind of lean on experiences from other crises to work your way through this crisis.
That said, this crisis is so far deeper than almost anything we've experienced in recent history. Your company makes work and project management software, working with a variety of clients from T-Mobile to ADP. We're getting more eye-popping jobs numbers, and I'm curious, given your vantage point as a CEO that works with other companies about their work, what do you see over the next few weeks? Are we going to see much more of this, and how much more pronounced does the economic devastation get?
People talk about a V shape or a U shape. What I'm really seeing is there are companies that are going to have a V shaped or a U shaped recovery. Companies are investing right now. We've seen very large companies just in the last few weeks make some significant investments in Workfront. In the last few days, one of the top 10 wealth management banks in the world, one of the top 5 media companies in the world, a Fortune 500 property and casualty company, a global toy company, even a large utility in the Northeast are making investments in a work management platform. So what I actually think is going to happen is there are companies that are going on offense, and they are preparing themselves to be able to manage a new world of work.
There's also a lot of discussion about how companies are treating their workers. Amazon, for example, has been in the crosshairs, a company that is clearly essential, keeping us connected, receiving our essential goods, and yet workers dissatisfied. You have Amazon announcing they're ending their hazard pay for their workers at the end of the month. You know, what's your take on the obligation of companies right now and whether or not they're actually fulfilling them?
Well, you know, what's interesting when we think about our customers, what they've been very focused on is how they can be resilient with their employees in a time of crisis like this. We're fortunate we've got a customer advisory board, a couple of dozen very large enterprises like a Prudential, JLL, Accenture, and we were able to bring those folks together virtually and kind of ask them in terms of responding to this crisis, what's happening inside of your companies. And kind of universally, what they talked about was this real challenge to help their folks to be productive in managing what I would call asynchronous work and synchronous work. And what that means is all these companies bought what I would call a crisis tech stack. They bought Zoom or Slack or WebEx, fantastic technologies. And what they told us in terms of their employees being able to be fulfilled at work is that in the areas where they had integrated something like a Workfront to those collaboration technologies, people were able to be successful. And where they couldn't, they were having a hard time managing work, tracking work, connecting remote employees to the most important work. Emily, just last week I talked to a major medical manufacturer, and they use Workfront to manage their entire product lifecycle. And this customer told me that in the first 2 weeks of the crisis, they didn't even miss a beat.
Now, some companies like Twitter, for example, has told employees they can work from home indefinitely. Is that something you would advocate? I mean, it seems the pendulum always swings in one direction, but it's bound to come back. And I wonder if that's maybe an extreme reaction.
You know, Emily, we've talked about our returning to our offices. And, you know, one of the things that I've told our employees is it's not about going back to our office, it's about going back to our office safely. And so it's not about, we're not going back to normal. There's going to be a different normal, but that doesn't mean it's a bad normal. It could be a great normal. But what I do know is whatever the normal is, it's going to include nomadic work. It's going to include work from home. And when that happens, you need some type of a technology platform to be able to manage the work. So whether or not people are completely work from home, clearly there's going to be nomadic work. And frankly, that's going to be good for companies like Workfront.
Okay. Nomadic work. That's a new phrase. I'm going to use that. Okay. Alex Shootman, CEO of Workfront. Thank you so much for joining us.
Thanks for having me. And
coming up, Facebook welcomes a new member to the family of apps, buying Giphy. We'll talk to our own Sarah Fryer about that coming up. Facebook's list of acquisitions just got longer with the adoption of Giphy, the maker of animated images known as GIFs. Facebook didn't disclose the terms, but sources telling Bloomberg the deal is close to about $400 million. I want to bring in Bloomberg Sarah Fryer, who covers Facebook, and I'm so glad we're covering this story, Sarah, because we get to show our favorite GIFs on television. But why did Facebook buy this company? What's the motivation here?
Well, it would seem to be about messaging and sharing GIFs, however you pronounce it at home. But the real reason that Facebook needs this service is because of the data. It's always about the data with Facebook. And with Giphy, they can get insight into how people are using these on all these different apps. They integrate with Twitter, they integrate with TikTok, with Slack, with iMessage, with Signal. They have all of these tentacles in all the different parts of the internet, and that is extremely valuable for Facebook. They have always tried, because they don't own a mobile operating system, they don't have Android, they don't have iOS. They've always looked for ways to gather more interesting insight on competitors, and so I think that that's the main reason. But of course, they're also looking for more ways that Facebook users can share, especially now that we're home during the coronavirus. We're not taking as many pictures of the things we're doing. We are sharing already recorded media a lot more, and I think that behavior is going to continue.
Right. It's been a bit of a moment for GIFs. Are we going to see more M&A right now? I wonder. You have companies that are struggling, companies that need funding, and I wonder if big tech is going to be coming to the rescue to some of these companies more often.
It's really interesting because at this very moment, Facebook is under antitrust investigation by the FTC, the DOJ, and 47 state attorneys general. There was just more antitrust news that hit on investigations of Google just now on the terminal. This is a really opportune time to scoop up a lot of these companies that are struggling, but at the same time, it's like never been more dangerous from a regulatory perspective for these companies to poke the bear, and they really are agitating. I mean, this Jiffy acquisition is exactly the kind of thing that the FTC is probing about Facebook. This idea that they have found ways to get insight into and then undermine or acquire their competitors. And so I think that maybe they can get away with it now, but it's going to come back in a couple years as these investigations really get underground.
And, as you alluded to, Giphy provides GIF search functions for other apps like Twitter, like TikTok. And, of course, those are, big Facebook competitors. Okay, Bloomberg, Sarah Fryer, thank you so much for joining us. Coming up, we're going to be talking about the New York Stock Exchange reopening its trading floor. We're going to hear from President Stacey Cunningham next. This is Bloomberg. Welcome back to Bloomberg Technology. I'm Emily Chang. We've got some breaking news now. This coming from the Associated Press, reporting that Tesla has chosen Austin, Texas and Tulsa, Oklahoma as finalists for its new assembly plant. Company officials, according to the AP, visited Tulsa this past week and were shown two different sites. Not clear if there are other finalists in the mix, but Tulsa and Austin rising to the top of the list. Now, earlier, the governor of Texas did say he's spoken to Elon Musk in an interview with local television news. He said, I've had the opportunity to talk to Elon Musk. He's genuinely interested in Texas and genuinely frustrated with California. We've just got to wait and see how things play out. And as will we wait to see how this plays out. Obviously, we've been talking about how Elon Musk has been frustrated with officials in California relating to the reopening of the Tesla plant in Fremont. All right, now I want to talk about the New York Stock Exchange, which will partially reopen on May 26th, but not everybody will be coming back just yet. President Stacey Cunningham spoke with Bloomberg's Sonali Basak earlier today.
It wasn't taken lightly. It was taken in consultation with public authorities, public health experts, but we put a plan in place that will be the first phase of our reopening. And what we'll do is the market makers that are typically standing at the posts around me right now will continue to work remotely. They're larger firms. They can do a lot of what they do from remote locations. And then the brokers that are small independent firms that are typically stand around the trading floor will come in the first phase. And so that won't require a lot of movement around the floor. We can limit limit interactions among people to just as an initial phase to get us back in and help those businesses that are most impacted get started.
What are some of the most important measures you think you'll be taking from the get-go to ensure safety of the people who are coming back in? And what will it look like in terms of density on the floor?
So given the protections that we've learned that are helpful to protect against COVID-19, everyone in the building and everyone on the trading floor will be wearing a mask at all times. We'll have 6 feet social distancing minimums applied across the trading floor. We're asking employees that come into the building not to use public transportation just initially because the shelter at home orders are still in place, and we're trying to respect those restrictions that the governor and the city have in place by keeping them us off of the subways and the public transportation systems, so we can leave that capacity for essential frontline workers in the healthcare system, and as well as limiting the exposure of different people that we're interacting with, so like keeping that much more controlled. We'll have temperature screening and medical screening as people come into the building. Some of the measures that we used in place at the end of March, but then layering on additional, such as PPE and social distancing restrictions.
And as we were saying, this must have been a very difficult decision. On the onset, what is your biggest concern as you start to open up?
Yeah, the decision-making process was about who's impacted most by these closures and how can we get to an increased level of service. We're going to live with this pandemic for a long time. We're not on the other side of it yet, and we're not going to be for quite some time. We can't leave the economy closed, but we can be thoughtful about what parts of it we reopen and how do we do that. So our plan is designed to focus our attention on slowly re-entering in a very cautious and very thoughtful, measured way, so that we can get that economy to reopen and start moving again without adding undue risk on the system. So we're not looking and we're not expecting that we're going to eliminate the likelihood of any case of COVID-19 because there is a pandemic that we're all living with. But our measures are designed to reduce the risk of an outbreak, and that's an important distinction. We've also are coming into this knowing that it's going to need to be a flexible situation. While we've outlined phase 1 and we have plans to increase the level over time, we also recognize that we might need to contract over time as local conditions change. And I think that's important for us all to be considering. How do we open up and start to re-enter and be ready to pull back as needed? This is going to be a learning curve, as this entire experience has been for all of us, but we learn so much week to week, and that's the information that we need to use as we make decisions.
Stacey, much lower density at the beginning, of course, in terms of people in the building wearing masks, you've already said, and we've seen a lot of the market makers be able to function electronically, not being able to come back right away. Do you think that some of the changes we're seeing at this time will permanently change some of the fabric of the New York Stock Exchange?
Well, what we've seen is that while the community has been able to operate remotely and we've been able to execute IPOs and still have complex transactions. In fact, today I'm standing right next to the logo of ADC Therapeutics, that is one of the largest biotech IPOs of the year, just priced this morning, and that happened remotely with the DMMs. While we can operate remotely, we operate better when we have people involved. And the data actually has been a really interesting, this has been an interesting experience to measure. And we can actually see, and the data supports, that we do operate better when human judgment is involved. So we'll go back to that full level of service. And this is just the first step getting us there.
New York Stock Exchange President Stacey Cunningham there. Well, earlier this week, the former CEO and chair of Google, Eric Schmidt, sat down with Carlyle Group's David Rubenstein to talk about how Silicon Valley is responding in the midst of the pandemic and what Silicon Valley looks like post-pandemic. Here's a portion of that conversation.
You have to solve both problems. You have to solve a horrific healthcare problem. And the healthcare workers in our country have done a fantastic job. If you look at the crisis. Remember, this all started because we were worried that the hospitals would be overloaded. We were terrified that we would have people in a heart attack, couldn't get to the hospital, people dying from heart attacks. We've managed to avoid that through an extraordinary work from many, many people at the state, federal, and local level and in the hospitals. So the second problem you have to do is you have to come up with some economic solution. The level of unemployment that we now have is on the order and approaching that of the Depression. We need that period to be as short as possible. And the Treasury has generally done a good job of getting money into the system, so we don't have a liquidity problem. I'm worried we have a bankruptcy problem. that eventually you can float the businesses long enough, but basically if there is no demand, they cannot stay in business, and those are permanent job losses. So when I look at the actions of the people, my primary criticism is the speed with which action occurred. If you think about it, much of the deaths could have been avoided now had we acted a month earlier in every decision. And that's basically the lesson from a pandemic.
You are a major philanthropist. How have you changed, if at all, your philanthropy as a result of the COVID-19 crisis?
Well, what we did is we decided to work on this because once it became clear this was not a 1 or 2 month scenario, we formed a special COVID task force, and we started looking for things that could act very, very quickly. And we've now given tens of millions of dollars in that area, with that number increasing over time. The initial focus was on things that could happen very, very quickly. The most interesting one was ventilator training. So it turns out that at the time when we thought we would need an infinite number of ventilators, nobody knew how to operate them. And so we funded a series of projects to train people on ventilators. Thank goodness we've not needed them as much as we wanted. Ventilators are not a good thing to be on.
So you've also been a venture investor. After leaving Google, you've stepped up your venture investing in many different areas, national security being one of them. What are you saying to somebody who might be a venture investor who wants to follow Eric Schmidt? What are you investing in?
Well, venture is a long game, and it's all about basically these key entrepreneurs, the men and women who have these ideas. So venture can be understood as find the entrepreneur, give them some money, help them recruit incredible talent, and then hope and pray and help them. And I don't think that's any different now than it was 30 or 40 years ago when I was in a small startup. So what I would say today is that, and I've always believed that biology was going to be an enormous business. And I think that the pandemic has emphasized the incredible scale of businesses that can be built now. The most obvious ones being in telehealth, right? Just think about in 2 months, you've changed the economics of healthcare that people were hoping to do in a decade or two. In 2 months, you now have reimbursements for telehealth, which allow you. Think about connected devices. Why are you not wearing a smart health watch that is communicating to a system with your permission and under HIPAA laws, which is helping monitor your health, and it calls you and says, you need to have a video conference with the doctor? Why is the system not essentially triaging patients in with video checks first? Take a picture of me, do an analysis, again, with my permission, and then say, Eric looks pretty good, and we'll ask him a few questions, and then we'll decide what kind of healthcare he really needs to be routed to. Is it urgent or is it not? That will make everything more efficient and, frankly, make my time more efficient as well. We can do this now.
Now, you are a person who's lived much of your career in the Silicon Valley area. How will Silicon Valley change as a result of this? Will it not just become bigger, but will people change what they do and how they operate these technology companies?
It's interesting that in my career, Silicon Valley has changed dramatically. And the large tech companies are now like large companies everywhere. They have whole institutions of governance. They have embedded competitors. They have opponents. They have political strategies and so forth and so on. And I don't think that's going to change. They're clearly going to be bigger, and certainly big tech will be bigger. And the simple answer there is because they're doing even more fundamental work.
Eric Schmidt there, the former CEO and chair of Google. All right, coming up, with unemployment in the tens of millions, that means tens of millions more people needing some mental relief. We'll talk to the CEO of Headspace about what they're doing to help people in need. Coming up, this is Bloomberg. This week, another 3 million Americans filed for unemployment, bringing the total number of unemployment claims filed to 36.5 million in the pandemic alone. That means millions more people potentially in need of mental support. Yesterday, Headspace announced it'll begin offering free one-year subscriptions to all unemployed people in the United States. Here to tell us more, CEO Rich Pearson. Rich, thank you so much for joining us. Of course, Headspace offers online meditation services and content, and this offering is really quite extraordinary. Tell us about it.
Yeah, well, thanks for having me on, Emily. Yeah, I think we as you know, as COVID hit, we were trying to think about all the different ways that we could help folks, and it quickly became apparent that our service was kind of needed more now than at any other time in our company's history, in the last 10 years. And as the unemployment figures started to unfold, and a lot of our friends and family and people that we knew were starting to lose their jobs, it was pretty clear that the mental impact of that, the mental health kind of crisis that's going to come from these numbers that you just mentioned, is going to last way into the foreseeable future. And so we wanted to kind of take the biggest swing where we felt that we could have the biggest impact with the resources available. So we decided to make it free for every single person that's unemployed they get a year's subscription. So that was the thinking behind it.
What kind of activity have you seen on the platform since the pandemic began, not just from individuals, but also from businesses?
Yeah, so in terms of some of our core content, so around our stress and anxiety, which won't be a surprise, we've seen up to 1,000% increase in kind of our core usage. And in terms of enterprises reaching out, I think what we found is that, there were a good number of companies that were discussing mental health in boardrooms. I would now say that every single company is discussing it as part of a way to look after and maintain the health of their employee base. And so we've seen up to 400% increase in terms of inbound inquiries from enterprises actually reaching out to us to ask for us to help kind of manage the health of their employee base. So we've just seen incredible uptick in kind of all of our core metrics.
Now, how do you plan for what happens when we come out of the pandemic? Like, what happens in the new normal? Do you worry about, a dip in all of this new demand? I mean, what does that actually mean for Headspace as you model this out?
Yeah, I think, look, our core, our vision's to improve the health and happiness of the world. And we've always believed that that starts with the mind. Like, we don't believe that you can, separate out mental health and physical health. They're inextricably linked. And I think that this crisis has actually just accelerated the mental health space by about, 5 years. We always felt that the market would kind of catch up to our longer term vision that we had, but I don't think this problem's going away. I think, we don't know what the new normal is going to look like when we return to work. But what I'm very confident of is that people have got a much bigger awareness of how important mental health is in our overall health and how it affects our physical health. And I think the science proves that out. And so I think when you've got business leaders, when you've got governments, when you've got schools, when you've got huge, parts of the population looking for services like Headspace, I don't think that demand is going to slow down. I think there's just going to be a much bigger awareness of the space in general. So I think it's going to be part of our culture moving forward.
All right, Rich Pearson, the CEO and co-founder of Headspace, thanks so much for sharing that with us. Again, free 1-year subscriptions for all unemployed people in the United States. Okay, coming up, VaynerMedia CEO Gary Vaynerchuk thinks people are spending too much money right now and aren't fully prepared for the full depth of the economic devastation that will continue to roll out over the next months and years. We'll hear from Vaynerchuk coming up. This is Bloomberg. Consumption habits are shifting dramatically from offline to online as people continue to stay home. We spoke to VaynerMedia CEO Gary Vaynerchuk, you may know him better as Gary V, about how that's impacting e-commerce, social media, and more. Take a listen.
It exploded when everybody got their stimulus checks. It reminded me how much of a materialistic, capitalistic country we are. I was actually disappointed. A lot of my businesses are in e-com, so I was quote unquote micro happy, but I was macro disappointed because I'm hoping that people learn how to save money during this time. Look, with VaynerMedia, my marketing firm, we sit with a lot of Fortune 500 companies that have consumer brands, and we're very involved in a lot of their e-commerce businesses. The numbers are through the roof on food and beverage and things of that nature. Obviously, I think clothes have been hit. So apparel has been hit. in certain ways, but net, like this is a capitalistic, materialistic country, and people want to buy things. And so I think you're seeing a ton of activity. Sports cards is a space I pay attention to. I can't believe how well it's doing during a time that I think people, I actually think the macro conversation is the way this is all playing out. I think it's disguising some of the economic vulnerabilities because we're still in this cocoon. I think that people still think there may be another stimulus check coming for me. As soon as this is over, I'm gonna get a job. I think the most interesting part of this from a kind of, thoughtful, economic standpoint is kind of that first month to 3 months, 4 months after it gets back to normalish. I'm really eyeing February, March, April of next year, where I think that you could see a dip because people are gonna be like, wait a minute, we're in something bad. Because right now I think it's fake to some people.
Interesting. So then how do you advise your companies about how to prepare for the new normal, not knowing what the new normal is going to be?
Every situation is different. In the setup of this question, the reason we decided to launch Vayner Commerce, even though it was a division inside of VaynerMedia, so now it's a standalone, was because everybody who sells something through a third party needs to figure out their e-commerce strategy. Like the thought to be reliant on retailers or Amazon or anybody else and not being the driving force of your own destiny of producing something and sending it to somebody is crazy to me. So for that, it's like, regardless of where the world is, try not to overextend yourself on CapEx, OpEx, and let's get into the game. For others, it's trying to mitigate their excitement on how good their numbers look so that they don't overspend. Meanwhile, because this is a complicated game, Facebook and Instagram and Google prices are down in costs in the auctions because a lot of people are not spending. So the customer acquisition costs right now are crazy attractive. So the cliche plays out, which is cash-rich businesses always accelerate aggressively during down times. If you have the ability to spend on acquiring customers right now and have a healthy business, this is a huge growth opportunity. For others, it's a re-strategize opportunity. Dwelling and going on full defense is only the answer if you're actually on the verge of going out of business.
Now, you mentioned Amazon, and Amazon has been mired in controversy about the safety of its workers, but still essential. Walmart, Target. Do you think this is a case of the big just getting bigger, or will we see a new landscape after this?
I think this is the big getting bigger, but I do think that innovation comes from times like this. And I do think that, when people really analyze their business, if you're selling through a retailer and you make a product, you're in a bad business. Walmart, Target, Albertsons, they have disproportionately too much leverage. If you're selling through Amazon, you're really just setting up the next giant that's going to have too much leverage, and they're going to ask you for more brand dollars and you're going to spend less on the consumer. So I think the change that you'll see, much like anything, you look at downtown supermarkets, now e-com, I do think you'll see fragmentation of products going direct to consumer, not through Amazon, not through Walmart. And I think that many in 7 years, when programs like yours are talking about that, many will talk to this time as the aha moment of like, we need to get our act together on going direct to consumer.
Interesting. So let's talk about the trends in social media and content. Obviously, we're seeing platforms like TikTok take off even more than it has been. Who are the winners and who are the losers in social media, and why?
I think stressful times or big things usually just expose things instead of changes them, right? So I think what you're seeing is, the same. I mean, look, TikTok is clearly the winner of this chapter. You have a lot of families at home together, and because TikTok won 13 to 22, those characters are spending more time with their parents, and everyone's looking for something to do, and you're definitely seeing explosion 30 to 40. I think Instagram in a lot of ways is such the juggernaut, but is definitely starting to get chipped away at. Everybody, one thing we've learned about social networks is they're more like actual TV networks and actual TV shows. They have a lifespan. So I think that's starting to lose a little bit its cool factor. TikTok still, it's at scale and growing. Facebook's dominating 45 to 90. From a loser, I mean, Pinterest is having a huge growth. I think Pinterest is a winner. People are cooking at home, visual search. I think Pinterest is a winner. I still look for Snapchat to do something to like change their fortunes. I always felt when Instagram came out with stories and gave them a real kind of punch in the gut that they needed to innovate to get back there. And so I'm a little disappointed, I guess, just because I'm rooting for as many. I want as much diversity as possible in social. So I think the biggest winners to me are Pinterest and TikTok. The biggest loser potentially is Snapchat, but I think they're stable.
Never a dull moment in an interview with Gary Vaynerchuk. Gary Vaynerchuk there, the CEO of VaynerMedia. And with that, that concludes this edition of Bloomberg Technology on this Friday. Wall Street Week with David Weston is coming up. We will see you back here on Monday. And don't miss our special Coronavirus, The Digital Front, which airs later tonight on Bloomberg Television.